So if we now redefine measuring risk and safety, not in terms of protecting our principal from fluctuating, but in terms of protecting our purchasing power from disappearing, we recognize a couple of things. One is, wow, not only has the industry been telling me something that's different than what I need to know, that bonds are risky, but they're telling me the opposite. They're telling that stocks are risky. They're telling me the opposite because investments that lead to the preservation and growth of my purchasing power, that's what I'm trying to do. I'm trying to preserve and grow my wealth. Those are fake, I'd argue. That's real assets. That's stocks. That's real estate. That's not paper assets. Bonds do the opposite. So now I've got to teach every investor not only to unpack the baggage that they've been misled to pack, which is that bonds are the safe thing, is that investments that lead to the preservation and growth of my purchasing power, those are safe. Stocks are safe, and investments that lead to the freezing and diminution of my purchasing power, risky. Bonds are risky. In the industry parlance, the advice would be 60-40 when you're retiring, 40%. In my model, it's going to be 90-10, 10% bonds, because there's different reasons. The extra 30% that the industry is advising on average for a client who's retiring in their 60s with a 30-year time horizon, that's an extra $3 million per $10 million that's frozen. So in 30 years, it would be still $3 million. You'd have long since run out of money. In equities in 30 years, or real estate, or some growth asset, at just 7% a year below long-term trend line average, that same $3 million, that's still $3 million in 30 years, that's worth maybe $300,000 if inflation, it would be $24 million. It would double 3 times at 7% a year. So think of the magnitude of what's being destroyed because the industry has it backwards.